Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 20th of March. I'm Daniel Lam, your host for the podcast. Investors have been nervously keeping pace with the events in the banking sector, in the US and also in Europe. This week, there's likely to be further volatility across asset classes, especially from the upcoming FOMC meeting in the early hours in East Asia on Thursday. Overall, the trend on macro data is still relatively strong. For example, we have had almost 1 year of non-farm payroll beats, the longest period over the last 10 years. However, because of the issues in the global financial sector, we believe the central case would most likely be a 25 bips hike from the Fed. ECB President Lagarde's comments at the ECB meeting last week suggest that central banks are starting to be concerned about, if not prioritize, financial stability over the fight against inflation. While the regulatory response so far should reassure bank depositors of the safety of the deposits, the evolving macro backdrop demands caution, as it is typical at the end of the economic cycle. So what should investors be expecting at the end of the economic cycle? Now, after 450 bips of Fed rate hikes in the past year, US money supply has started to contract. Banks have started to tighten lending conditions, and savers are seeking refuge in the most secure banks for their deposits. Consumer spending is likely to be the next shoe to drop. We believe these financial stresses signal financial conditions have tightened enough to cause a recession sooner rather than later. While inflation remains elevated in the US and Europe and job markets are tight, these have been historically lagging indicators. So therefore, the above backdrop reinforces our belief in the safe investment strategy. First of all, recent market performance confirmed our preference for high-grade bonds over all other assets. While DM government bonds have delivered, DM IG and Asian dollar corporate bonds have also gained over the past week. We would look to increase maturity in our high-grade bond allocations on any banks in bond yields. Secondly, within equities, we would continue to rebalance from DM equities to Asia ex-Japan, particularly China equities, as Asian growth remains resilient, in contrast with looming recessions in the US and Europe. Also, among sectors, the technology sector, where long-term growth drives much of its value and is thus very sensitive to rates, is a proxy for those seeking to benefit from the rates pullback. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.